Welcome everyone. Today's topic is structuring your business, learn the updates on the entity laws and fundamentals. Okay. Um, our special guest Patrick New unfortunately is not going to be able to join us today, but I'm going to give you a quick introduction and let's dive into it as to why it is so critical for you to understand your structure, your entity, and how to proceed next. Okay. Well, we're going to so here, let's talk about understanding risk and liability. The objective of having your entity, number one, is to be protected. Your personal assets need to be protected. So you need to have like a firewall in between you, your personal assets, your family, and your business. Okay, so that is the main objective of creating your entity for asset protection. Okay, so I'm going to write these down because there are three main advantages of having your entity. So this is what we're going to do next. We're going to write them on the board. Okay. Okay, I want to make sure that you all can see it. So number one advantage, asset protection. Okay, so you're going to have a wall between your personal assets and your business, whether you do flips, wholesales, or rentals. Okay, now the second advantage is when you have an entity. Okay, and we're going to go into the details as to what entities make the most sense. So second point is for funding purposes. Okay, funding. And I'm going to tell you quickly why that is important. Because hard money lenders, private money lenders, any lender that is going to give you funding for your deals, guess what? They're going to make sure that you have an entity. Why? Because if they give you money, okay, if they give you money to your name, let's say John, okay, John Doe, versus giving money to ABC Inc., okay, you may think that it's the same thing, right? Because behind ABC Inc., there is John Doe, right, as the president. Well, there's a big difference. Let me remind you, the foreclosure process in Illinois for an individual can take up to 2 years, okay? So if, for instance, John Doe defaults on the payment, the bank, the lender, needs to go through the court system, and the foreclosure process on John Doe is going to take up to 2 years. However, if they foreclose on the entity, it can take as little as 6 months. You see the big difference? That is why funding to your entity is going to be the way for lenders, okay? So they don't want to give you money under your personal name. It's too risky for them. Of course, they're going to vet you. They're going to make sure that you have liquidity, good credit, and so forth. However, there's no guarantee for them. So they want to make sure they minimize the risk by giving you loans for your entity, even though behind the entity is John Doe. But the big difference is that Illinois is a judicial state. What it means is that for the foreclosure process, when people default, the lender has to go through the court system to foreclose on the owner. That is a lot of bureaucracy, therefore it can take up to 2 years. However, there are some states, like in California, the West Coast, they're non-judicial. So lenders do not need to go through the court system to foreclose on the owner. Therefore, they can foreclose on the owner in as little as 6 months, but not Illinois. Illinois is a judicial state, so the lenders have to go through the court system. So in this case, boom, get funding for your entity. So that is the second biggest advantage as to why you need to have an entity for your business. Now let's talk about the third aspect. Why is it important? For tax benefits, okay? You might wonder, well, taxes, I'm not an accountant. The tax law is huge, nor do we need to know the details, right? Because we're real estate investors, we're not accountants. So why is tax a big, big difference when you have an entity? I'm gonna tell you the secret. It's called depreciation. Depreciation, okay? That is huge. What it means is when you own real estate, okay, you're gonna be able to depreciate the property for its lifespan. So whenever you do a project, let's say you do a kitchen or a bathroom, the lifespan depreciation period for any project, like for instance for a kitchen, I believe is 7 years, okay? So you're gonna be able to do a lot of write-offs. So the biggest tax benefit on real estate is tax depreciation. So when you have an entity, your accountant is going to give you a pass-through schedule for your income tax, and that's where your accountant is going to take care of these main benefits, depreciation for any real estate that you buy, okay? So let's just quickly summarize the three benefits. Number one, asset protection, right? So let me give you a quick example. If you buy a property and then you get sued for whatever reason, either somebody falls in your property or something collapses in your property and you are not protected, meaning that you don't have an insurance policy or your property is under your personal name, guess what? They're going to sue you and they're going to go after not only your rental property, but they're going to tap into your personal assets. So it's a huge risk, right? Therefore, when you have an entity and that entity is buying your real estate, guess what? Even if they sue you, the most they're gonna tap into is your property. Like the collapse of the porch about 10 years ago, the owner ended up losing that building, but that owner owned many more buildings. So he had not only the property under an entity, but he also had an umbrella policy. So umbrella policy is critical for you to be 100% safe when it comes to liability. Because if the lawsuit exceeds the property value, let's say whoever fell in your property and your property is worth 300,000 in equity, but the lawsuit might be for 500,000, then the umbrella policy kicks in. So it never goes into your personal asset. So number one benefit is asset protection. Number two, funding. Lenders want to give money to your entity, not to your name, because of the foreclosure process in Illinois. They can foreclose on your entity in as little as 6 months. Third benefit, tax depreciation. That's a huge write-off, okay? So wealthy people have investments in real estate. Why? Because if they make $100,000, they're going to get to keep most of it. And that's the big difference between real estate investors and other type of investors, right? They might invest in other type of mechanisms. In real estate, you have a huge benefit, which is depreciation. Okay, so if you make 100,000, you're going to get to keep most of it. Why? Because of depreciation. Okay, so now let's talk about what are the entities, right, that you're going to be using to do all these, to take advantage of all these benefits. So let's just go over that. I'm going to erase these benefits, and then let's just quickly talk about the types of benefits, the types of entities. We're going to send you, when you register for the webinar, we're going to send you a PDF. Phil, can you make sure that we send the link for people to register so they get the PDF that I'm just about to show on the screen with all the pros and cons of the different entity types. But let me just quickly summarize the ones that make the most sense and the ones that have the biggest advantages, okay? There are two. So you have the S Corp, and then you have the LLC, okay? There are many more, like sole proprietorship. They have the C corp. I'm gonna write the C corp, for instance. Okay, but the ones that I want you to focus on, and that's what most investors have these. They have either an S corp or an LLC, regardless of your exit strategy. So these are good for rentals, flips. Okay. If you're going to do wholesales, it doesn't really matter because when you wholesale, you are not buying the property, right? So there's very, very little or no risk at all. So it doesn't matter. If you're doing wholesales, you can do it under your personal name, you can do it under your trust because you have nothing to lose but the earner's money. And of course, your worth is on the line with the owner you are trying to help. Right? So it's a big moral responsibility when you're wholesaling and you cannot follow through and buy and find a cash buyer or an investor to reassign the contract. So that's a separate story. But if you're in real estate for flips and rentals, it doesn't matter. You can do either an S corp or an LLC. Now, why am I going to get rid of the C corp? I'm going to put a big X on C corp. C corp has double taxation, okay? Double taxation at the personal level and at the corporate level. So right off the bat, I'm not even going to talk about this because it has a huge drawback. Only huge corporations can really leverage from C corps. But if you're an individual or you have partners, you need to focus on S corps and LLC. They don't have double taxation. They are pass-through entities to your personal income tax. Now, the question is, which one should you use? Should you use an S corp or an LLC? There's a very simple rule of thumb. If it's only you can create an S corp, okay? But if you have more partners, okay, 2 or more people, then create an LLC. It's very simple. When it comes to doing your taxes, you need to file a tax return for each of those entities, okay? So, but you want to keep it as simple as possible. Again, one individual, S corp, multiple individuals, LLCs. Now, how do you set up an entity? Okay, my favorite resource and the one that we've been using a lot, it's called, I'm going to remove this C corp, LegalZoom.com. So I'm going to write it, LegalZoom.com. Okay, you're going to spend about $400 to $600, but in about a week's time, you're going to be able to get your entity. So what does that mean? You specify, once you create your entity, let's say you're doing an S corp, you're going to get the articles of incorporation. They're going to give you an operating agreement, and those are the 2 pieces of document that you're going to need. As an optional document is going to be your bylaws. Okay, so you're going to get 3 documents. One is going to be the articles of incorporation. Okay, these are very important. That is states that shows that you incorporated with the state of Illinois. Okay, that makes you official that you have an entity. The second document is going to be your operating agreement. Okay, the operating agreement is going to state what you do, and this typically applies when you have an LLC, right? When you have more than 2 members, you're going to state what each of you bring to the table, or your responsibilities, your contributions, and your returns, right? How you're going to do the splits, who's going to be taking care of accounting, who's going to be doing the rehabs, who's going to oversee the project, who's going to be in charge of marketing. So this is in the operating agreement where you specify each member's responsibilities, contributions, and returns, right? So depending on how many members you have a split 30, 30, 33, or whatever the number may be to make it equitable, okay? So this is super important to make sure that everyone understands what the responsibilities are. So when you request funding, right? They're going to ask you for these two documents. They want to see the articles of incorporation, they want to see the operating agreement, and sometimes they're going to ask you for what's called a certificate of good standing. Okay, so it's a certificate of good standing. So this certificate, you can get it from the CyberDrive website from Illinois, that just states that your business has filed taxes, that you have paid the yearly fee. That's about it, okay? And then you're gonna pay about $25 to get this certificate, but some lenders are gonna be requiring this. But for now, focus on getting the articles of incorporation, if you still don't have them, and the operating agreement for your entity. So again, if it's only you, do an S Corp. If it's you, your wife, your spouse, your partner, significant other, do an LLC, okay? Now, one of the questions that a lot of people ask, well, should I create one entity or one LLC for every property that I buy? The answer is no, because you're gonna complicate your things, your accounting, because for every single entity, you're gonna need to file a tax return on a yearly basis, okay? So the way to approach this is as follows. I'm gonna delete these. I wanna make sure that you wrote these down. LegalZoom.com is my favorite resource where you can get incorporated in as little as about a week, okay? So now let's talk about, should you put a property under an LLC, or should you put two, or should you put three properties under an LLC? I'm gonna give you the rule of thumb. So you're gonna create let's assume you're an individual, just yourself, and you bought one property today, in about a month, another one, and every month you're buying one property. So you end up with, let's say, three properties, okay? So the question is, should you put each property under one S Corp each? So S Corp here, S Corp here, S Corp right here. The answer is not quite. It's going to be driven by how much equity you have in each property, okay? So you don't do that. You don't want to do that, okay? So if you have three houses, what you want to take into account is how much equity do you have in each house. So let's assume that you have 50,000 here, you have 70,000 here, and then you have 80,000 here, okay? You're gonna put all these properties into one LLC until you reach 500,000 in equity, okay? That's just a rule of thumb, because it doesn't make sense to put very little equity that is at stake in case there's a lawsuit under one LLC, right? But when you accumulate a lot of equity, meaning your net worth reaching $500,000, then it's time to start moving properties to a new LLC, okay? So if this reaches that point, let's assume that you have 300,000 in equity here, you have 2,000 in these, and then you have maybe 100,000. Okay, so you have by far exceeded the 500,000 already by 100,000. So this is time to move one of these properties into a new LLC, okay? It doesn't matter which, but you're gonna need to move one of these outside, because then you have a lot in the stake at this point, okay? So if there was a huge lawsuit, obviously your umbrella policy is gonna kick in, but you wanna make sure that you have up to 500,000 in equity under one single LLC. And obviously this applies for rentals, okay? When you do rentals, because when you do flips, it doesn't really matter, because when you sell the property, boom, you sold the property, okay? So it doesn't really matter. When you do flips, you will probably not reach 500,000. So if you're gonna be doing flips, just use one single LLC, because At one point of time, it's very difficult for you to reach 500,000 in equity doing flips. So you're going to be okay holding all your flips under one LLC, okay? Now, a lot of people ask, well, what about if I'm going to partner up with somebody else? Should we create an LLC, right? So this is my rule of thumb. If you're going to work with somebody new for the first time, you do not need an LLC. You need a joint venture, okay? So I'm going to make sure that you understand this. So you don't need to create an LLC. All you need to do is a JV, a joint venture agreement. Okay, so if you're going to do a flip, let's say you're going to do a flip with somebody that you met recently, you don't want to create an LLC for that because you want to make sure that you do multiple flips with somebody that you feel comfortable with, that things are working well before you create an LLC. Because creating an LLC, it's overhead, right? You're going to need to create your operating agreement. You're going to need to incorporate with the state. You're going to need to file taxes. You want to do a joint venture, okay? So a joint venture is just an agreement between you and the other individual, and that agreement will specify each of you what you're going to do, your contributions, your returns, your responsibilities, and so forth, okay? So don't overkill it and do an LLC with somebody that you're going to partner up with to do your first flip or your, does that make sense? So make sure that you do a joint venture. We have a joint venture agreement. If you need one, please make sure that you register for today's event, and we're going to email you a joint venture agreement, okay? Because I want to make sure that you keep things simple, but at the same time that you are legally protected, okay? So again, joint venture with somebody that you are going to do business or partnerships for the first time. If things roll great and work amazing, then you can consider doing an LLC because you're going to need to do a little bit more overhead with an LLC, okay? Now, that we mentioned partnerships. This is very important. Some people say, well, should I partner on rentals? Should I partner on flips? Does it really matter? Well, it does matter. Let me tell you the rule of thumb. You don't want to partner up with anybody on rentals, okay? Why? Because rentals, it's a long-term investment. It's like being married to somebody, right? You're in the long haul with that individual. And it's very difficult because over time, we go through many life events, so things could change for us. So you don't want to have a partnership for rentals. It's best to go in and out with partnerships or joint ventures on flips, okay? Flips are just in and out, right? Maybe somebody puts the money, the other person manages the rehab, and then you split the profit 50-50. So very straightforward, very simple. With a joint venture agreement, you can accomplish that partnership on flips. But on rentals, it's more complicated because let's assume that you bought a property together and then somebody decides to sell the property, right? So now what are you going to do in that case? Guess what? You're going to need to buy them out. You're going to need to refinance the property. So it is a lot more work and stress and unwanted overhead. Does that make sense? So keep rentals for yourself. If you are in need of funding, all you need to have is a great deal, and funding is readily available. Okay, when you have a great deal, private money lenders, hard money lenders are going to give you the money, so long you know how to present the deal. So we're going to do a session just on presenting deals to get them funded. But for now, let's focus on having your fundamentals in place. So you have to have an entity. Let's just quickly summarize what we went over right now, and then we're going to take questions. Why do you have to have an entity? For 3 reasons, okay? So reason number 1, asset protection. You want to make sure that your family, your assets your house, your vehicles, everything that is personal is protected from your business. Okay, if you're gonna do flips, rentals, and things go sour, you are gonna be okay. Okay, that is the reason number one why you need to have an entity to protect your personal assets. Reason number two, funding. Lenders will want to give money to your entity. Should you not pay, they can foreclose on your entity in as little as 6 months. But if it's under your personal name, whoa, tough luck, up to 2 years in the foreclosure process. And nowadays that things are still closed, it can take even longer. That is why for funding purposes, you need to have an entity. Reason number three, tax benefits. And the biggest tax benefit is tax depreciation, okay? Write-offs. You're gonna be able to write off so much that if in your entity tax return is going to be a pass-through to your personal tax return. So you're gonna end up paying a lot less in taxes. Super important. Those are the main reasons. Now, let's talk about what entity should you get, okay? Just a quick summary. Stay away from C Corps because that takes double taxation. Either do S Corp if it's only one individual, yourself, or LLCs if it's multiple individuals. But again, if you're gonna be doing a first flip with somebody, do a JV. If that works, then do an LLC with that individual, okay? Just keep it simple. Focus on getting the deal successful and sell it. Now, if you're gonna be doing wholesales, it doesn't matter because you are never buying the property, so there's no risk. Your assets are not at risk when you're wholesaling. Does that make sense? So you do not need to have an entity when you wholesale. You can do it under your personal name, or many wholesalers do it under their a trust, because a trust is a hiding mechanism, okay? So it's up to you, but again, just keep it simple. If you're gonna wholesale, to begin with, do it under your name. It doesn't need to be an entity because there's nothing at risk when you're wholesaling, okay? Now, if you're gonna do rentals or flips, which entity should you use? It doesn't matter. What matters is that you're gonna be protected. So use either an S Corp or an LLC. Now, should you create an entity for each property that you buy, assuming that you're gonna be doing rentals? The answer is no. The rule of thumb is it's driven by equity. Reach 500,000 in equity under one entity, and then you can start moving those houses out into a new entity. Does that make sense? And lastly, stick to JVs. When you're gonna work with somebody else, we're gonna give you the joint venture agreement, and also we're gonna give you the pros and cons of every single entity, like the S Corp, the LLC, the C Corp, partnerships, sole proprietorships. We're gonna give you the pros and cons. But as a rule of thumb, I like to keep things very simple, right? I hate complexity. That is why I'm just giving you the rule of thumbs and sharing how we do things and why we do it and the importance of you getting this done. So if you still don't have an entity, please check LegalZoom.com. There, you're going to spend about $500-600. It's going to take about a week, and you are going to get your operating agreement. You're going to get your articles of incorporation, and as an optional document, bylaws. Some lenders are going to ask you for a certificate of good standing. Okay, that's about $25 from the CyberDrive website. So now it's time for questions. So let's review the chat and see what questions there are. Okay. Okay, so Laura, if we get an S Corp or an LLC, but only name ourselves, can we later change it? We're saying absolutely. You can always make changes to the entity, right? So you're gonna update the operating agreement. You can remove individuals. So just a tip of advice, when you create an LLC, right, multiple people, you're gonna need to have a percentage of ownership in that LLC. So let's assume that you're gonna partner up with 3 people, okay? So we're gonna add a third person right here. So if you are the person who has the most to lose, let's assume money, right? So this is you. Please make sure that you have at least 51% ownership, okay? Because if you don't, guess what could happen? If you have 33, 33, and 33, right? And let's say you are the one who has a lot to lose in this partnership because let's say you're putting the money or you're doing most of the work. Guess what could happen? These two people can vote you out because they're going to add their ownership percentage that adds up to 66%, and boom, they can vote you out. Okay, so you never want to have less than 51% on the LLC if you are the one who has the most to lose in the partnership. Does that make sense? So please keep that in mind. So great question, Laura. Great question. So make sure that you always have more than 50% ownership because then there's no way anybody is going to be able to vote you out. Another question is, after reaching 500,000 in assets, do you move them to an, exactly, you need to move them to a new entity. So once you reach 500,000, make sure that then you create another, either S Corp or LLC, and put that new property into that new LLC. And the way to move properties from one LLC to another one is by doing a quit claim deed, okay? That gets recorded, and that's how you can move properties from one entity to another entity. But if you have a loan on the property that you want to move, then the lender needs to be okay by you changing the entity. Okay, so you need to get the okay from the lender because technically they still have a first position lien on that property. But the way to move properties is doing a quit claim deed. Great question. Are there any other questions on the line? Any other questions that you can think of on entities? Can the articles of incorporation, what's the question, Laura? It just cut off. Any other questions that you may have? Okay, slow typist. Oh, no worries. Can the articles of, or you can unmute yourself if that's easier. You can unmute yourself and then ask the question. Okay, friends, so if no further questions, okay, there's another question. Can operating agreement and build also be changed? Oh, bylaws, yeah, absolutely, yeah, absolutely. Your bylaws, your operating agreement can be changed. Yes, at any time, and that's part of the business. The only thing that is constant is change, right? So you're going to need to be able to modify these. But again, if you're going to be doing business with somebody else, start with a joint venture agreement, okay? And then move on to creating a legal entity if you think that's a partnership that is going to continue for several years. How would that be done? Okay, so you can have, you need to record these with the state, every JV, every partnership that you create so that it's legal, right? So you can amend, you can make changes, and then you just need to record the amendments to the operating agreements, to the bylaws. Great question. Another question is, someone recommended Wyoming Holding LLC to own the property LLCs. What are your thoughts? So you want to, it doesn't matter where you create your entities. In fact, many people created in the past entities in Vegas, just for hiding mechanism, right? Like they're going to find you. If somebody goes wrong and you get sued, they're going to find you regardless of where your holding companies are. So it's best to register the companies in the state that you operate. So if you're in Illinois, just keep it simple, right? Because nowadays, having everything being public, it doesn't really matter. Even if you have a trust, which is a hiding mechanism, it doesn't matter. They're going to find you, right? You just need to make sure that you have an entity and you create it in the state that you live in or that you do business in. Super important, okay? Do not complicate your life. Just keep it simple. Again, do an S corp for you or LLC for multiple partners, but start with JVs if you're going to do flips with somebody. Avoid partnerships on rentals just to keep it simple. And if you are going to do an LLC with other people, make sure that you hold at least 51% ownership. If obviously you have the most to lose, the biggest three benefits of entities: one is asset protection, two is funding, three is tax benefit, depreciation, okay? And then you need to have up to 500,000 in equity before you start thinking about creating another LLC, okay? So mistakes people make, I'm gonna tell you. They create one entity for every property they buy. Whoa, that's a lot of overhead, and every year you're increasing your tax return fees by $400 to $600, okay? So it becomes a headache. Don't do that. Second mistake, people partner up. They create entities, LLCs, with somebody new they met. They want to do their first deal. No, because if things go sour, again, you have just incurred expenses, filing fees. Now you need to file a tax return. You have to dissolve the entity. So a lot of overhead. Start with a JV. Make the deal successful, and then you can think about doing a legal entity, okay? Another mistake people make is not having enough ownership in the LLC, okay? If they don't have enough ownership, they could be voted out, okay? That's another mistake. Another fourth mistake is that people don't have enough insurance. You always have to have an umbrella policy. You may wonder, how much should I buy insurance for? Take your net worth. If your net worth, meaning your assets minus your liability, okay? Let's say if it's 100,000, multiply that times 5. So you need an umbrella policy for at least 500,000, and it's extremely cheap. I think we have one for over $1 million, and it is like $130 every year. So make sure that you always carry an umbrella policy. So if you don't have one, contact your insurance agent ASAP. You need to have umbrella policy, okay? So in case you still a lawsuit goes over your entity's equity, you're still protected. Your personal assets are still protected, okay? Another question is, 500,000 seems high. If I don't have barely anything at all, wouldn't that be risking potentially? So, I mean, that's just the rule of thumb, 500,000, but some people may feel that is way too much. I mean, maybe 250,000 if you feel more comfortable, and then you start creating new entities for other properties. But the rule of thumb, the big guys, everyone, once it reaches 500,000, they create another one, okay? But if you know, depending on your personal risk level, tolerance, by any means, you can cut that by half. 250,000, create a new entity. But just don't do an overkill, right? That's the mistake that I've seen investors make, is that they have $50,000 on a property and boom, they put it in an LLC. And they have another 70,000 in equity in another property, boom, they put it in a new LLC. You're complicating your tax return. You're increasing your fees. Just keep it simple. Simplicity is the most sophisticated element in real estate. Real estate is already complicated. We're trying to give you the shortcuts, the secrets for you to keep it simple. So let's just keep it simple, okay, and be more productive. How often can you change the tax designation? Oh, you can change and make amendments as often as you need, okay, and that is common, okay. When, let's say, a partner leaves the LLC, you need to remove them. You need to make an amendment and then record that with the state, with the recorder's office, okay. Great questions. So Phil, can you please give everyone a 30-day free trial for ChicagoDealVault The promo code is entity. Okay, you guys are gonna get a 30-day free trial for Chicago Deal Vault. Chicago Deal Vault allows you to access MLS properties, off markets, properties like pre-foreclosures, probates, shadow inventory or REOs, vacant properties. We have cash buyers for your wholesale deals, private money lenders, over 8,000. Preferred partners, over 100 preferred partners. We give you access to people we use. We give you access to them. Error reports, over 300 error reports. You have all of that available to you. And we are going to send you an email for those of you who registered with 2 documents. We're going to give you the PDF, okay, with the pros and cons of every single entity. We're also going to give you a copy of the joint venture agreement, okay, because I want to make sure that you partner up, but you start with joint ventures, okay, and then you move up to having an entity. And then please make sure that use RSVP for tomorrow's event, okay? Phil, if you could please post it on the chat. Another question is, how does it complicate taxes by having too many entities as you described? Oh, okay. Because each entity, you need to file a return, a tax return, okay? So your accountant is going to charge you between $400 to $600 per entity, plus you need to pay legal fees to the state for every entity that you own. So you're going to incur about $800 at least per entity. So if you have 5 entities, you're just going to pay $3,500 a year in legal fees, okay? Because you need to think the objective is to be protected. You're not going to be any more protected by having more entities. It's the opposite. The more entities you have, the more you're complicating and increasing your fees. Okay, so you want to just have enough to be protected. And again, that's driven by the equity. If you believe 500 is too much, keep it down to maybe 300, 250,000 before you create a new entity and put your rentals in there. So great questions. Do you recommend opening up a separate bank account for each entity? Absolutely, great point. For every entity, you do need to have a different checking account, okay? Super, super important, okay? And in fact, let me tell you what we do. For every property, we have a different checking account. We just don't commingle funds for different properties. Because getting a checking account is just so simple, right? You want to make sure that, for instance, when we do our profit and loss monthly statement, right? All we do is we send our bank statements for one account, and then we get the profit and loss back for that particular property, right? So it's very simple to keep your accounting separate by having a checking account for every property. That works amazing. I know other investors, they have only one checking account for maybe 2-3 properties. Well, if you start rehabbing or doing a lot of incurring a lot of expenses on all 3 properties, guess what? You need to manually separate the expenses into its appropriate profit and loss report, right? Because otherwise it's going to be a big mess. You don't know if property A is cash flowing, if property B is cash flowing. It's going to be a big disaster unless you're on top of it on a daily basis. Just to keep it simple, we do create a checking account per property. When somebody goes out to the property and we need to pay them, we do a Zelle payment from that particular account. So at the end of the month, we know how much we spent in repairs, projects, and so forth, what the income was, right? So we can just look and download the statements, the transactions for the last 30, 60, 90 days, and boom, we can do a P&L in minutes. So super important. Great question. Okay, thank you for asking that. Now, another question is, do you recommend, great. Another question is, do you suggest to put the funds to, Walter, I'm not sure what the question is. The property gets set up tax basis when it's passed to their HERS. How do you pass properties in business to HERS to get step-up basis? Can you pass businesses with properties inside and those HERS still get set up basis? So the question is, how do you pass properties to your heirs, okay? So the way to do that is quitclaim deeds. So when you do a quitclaim deed, that's just a way to transfer ownership from one individual to another one. So if you are still alive, you want to create a will, right, to specify who gets what. Very simple. Always have a will, and if during your present life you want to assign certain properties to your heirs, just do a quitclaim deed, okay? But for sure, everyone needs to have a will and specify your wishes in there, who gets what, and so forth. So great question. Another question is funds from each entity into a separate bank account. I have had banks commingle assets for me, therefore. Oh, okay, so Walter experienced commingling of funds within the same bank for different entities. I've never had that case, but it's super important for us. We use Bank of America and Chase, but for every property, we have a different checking account. Super critical. Okay, so for instance, if we have 5 properties under one entity, so the checking account obviously is going to be under, let's say, the entity name, but it's going to be ending in 01, 02, 03. So each property will have a different checking account. It's going to be under the same entity name, but it doesn't matter so long you have a different checking account for every property for accounting purposes. Okay, you don't want to commingle funds between properties, and especially personal and business. You never want to commingle. Super, super critical, especially when you have rentals, right? And then you're going to do security deposits. You need to have an escrow account, a separate escrow account for security deposits. So great points. Whoa, somebody had that happen. Whoa, Walter, that's I don't know what bank you use, but yeah, we've never had that issue with Bank of America or Chase. Same question as his, but I don't want it changed until after I pass. What type of transfer is best and why? So if you want certain properties to be passed to your heirs after you pass, then you need to have a will. And the way it's going to work out is when somebody passes, then the next thing is that your heirs are going to open up what's called a probate, right? And the judge is going to, first of all, find out if there's a will or not. If there's a will, in the will, you're going to specify who your executor or administrator is for the will. And then it specifies who gets what and when, okay? So that just makes things easier for your heirs when you do have a will. And obviously, it has to go through the court system, through the probate, to make sure that, you know, they open up the probate, they find out if you have a will. If you don't have a will, guess what? The state is going to assign an administrator for your assets, okay? And they're going to determine if you have heirs or not, and then they will assign an executor. And obviously, the executors, the heirs, are going to do with the properties whatever they want. Obviously, they need to pay the creditors or the mortgage payments, liquidate that. Sometimes, most oftentimes, I see they sell the properties because they obviously want to cash out. So the heirs don't want anything to do with real estate. They just want to cash out. They want to pay the creditors, and what's left, they want to keep, right? Always, please make sure that you have a will, okay? Great question. So somebody used Chase and Fifth Third Bank. My favorite bank is Bank of America, okay? I love Bank of America. Chase, we also have Chase, but it's not my favorite. Let's put it that way. Okay, yeah, it happened to you with Chase. Whoa, okay. So yeah, the best way to transfer ownership is doing a quitclaim deed. Okay, that's just the simplest and easiest and cheapest way to transfer ownership. Quitclaim deed. So great questions, everyone. If no further questions, thank you everyone for joining. You are going to get the replay. Make sure that you register for today's event because tomorrow, first thing in the morning, you're going to get the replay and also 2 documents. The pros and cons of every single entity, okay, when it comes to taxes, And two, you're going to get a copy of our joint venture agreement that we use when we do partnerships. Another question is, what is the transfer fee versus quitclaim deed? Transfer fee? I don't know what transfer fee is, Laura. I'm sorry. Quitclaim deed is just the easiest way to transfer ownership of a property. So thank you everyone for joining today. I look forward to seeing you tomorrow. Okay, we have a webinar at 6:30. So I'm trying, the whiteboard. This is something new. I hope it was helpful because when you visually see things in writing, it makes a big difference. So please take notes. And I like to keep things very simple. So thank you everyone for joining today. If you don't have DealVault, please make sure that you take advantage. Please post the instructions. You're going to get a 30-day free trial. The promo code is ENTITY. So thank you everyone for joining. I look forward to seeing you all tomorrow.